Hello everyone! Today I'd like to introduce you to Flexible Spending Accounts FSAs, which can help you save 20% to 30% of medical and daycare expenses. Before we begin, English is not my first language, so I may mispronounce words or say things in a way that is unclear. I appreciate your understanding. Thank you. In the US, employees at companies typically have the opportunity to choose their benefits for the following year during the open enrollment period, which usually takes place around October to November. During this time, you can optionally enroll in an FSA flexible spending account. I started using an FSA a few years ago, and honestly, I regret not doing it sooner. I had heard it was tax advantage, but I didn't realize just how much I could actually save. I hope you'll take advantage of it early and start saving too. The next opportunity to enroll will likely be this October and November, or when you are newly hired. It may seem a bit early, but I decided to make this video to share the information. There are two types of FSAs, one for healthcare and one for dependent care. If you anticipate medical expenses or know you'll be paying for childcare, this is a system you should absolutely consider because it lets you save the amount you would otherwise pay in taxes. Healthcare FSA. This account allows you to set aside money from your pre-tax salary to cover out-of-pocket medical expenses for the upcoming year. Dependent Care FSA, DCFSA. This account lets you set aside pre-tax income to pay for dependent care services such as preschool and daycare. If you work in the US and your employer offers health insurance benefits, you typically have one opportunity each year to enroll in a flexible spending account FSA when selecting your coverage for the following year. Mid-year enrollment is not allowed, but you may be eligible to enroll when starting a new job or if you experience a qualifying life event such as childbirth, depending on your employer's policy. Let's take a closer look at each type. Let's begin with the Healthcare Flexible Spending Account, Healthcare FSA. This is a system where you estimate how much you'll pay out of pocket for medical, dental, and vision expenses over the course of a year, and then set aside the amount from your pre-tax salary through payroll deductions. The plan year runs from January 1st to December 31st. You can use the funds not only for your own medical expenses, but also for those of your dependents and spouse. Eligible expenses include not just copayment and deductibles paid to medical providers, but also prescription eyeglasses, hearing aids, clutches, health monitoring devices, and prescription medications. Since the pandemic, over-the-counter medications without a prescription have also become eligible, along with menstrual care products. The amount you choose to set aside must be determined once per year during enrollment and cannot be changed later. For 2025, the annual contribution limit for a healthcare FSA is $3,300. This amount is reviewed annually and has increased by $100 compared to last year. Your contributions are exempt from federal income tax, Social Security tax, and Medicare tax. They are automatically deducted from your paycheck before taxes are applied, making this a tax-free way to save, effectively reducing your taxable income. For example, based on a rough calculation, when I lived in Hawaii, I estimated I'd pay around $2,000 out of pocket for dental care in a year. By contributing $2,000 to my healthcare FSA and assuming a 20% federal income tax and 10% Hawaii state income tax, I saved about 30% or $600. That's a significant benefit. If you need the full $3,300, your potential savings could be around $990. Even if you live in a state with no state income tax, you'll still save about 20% thanks to the federal tax exemption. One important note, if you don't use the full amount you elected, the unused portion will not be refunded, so it's crucial to estimate your expenses carefully. I'll explain more about that later. System overview and how to use it. Once you enroll, the full amount you elected for the year becomes available starting January 1st. However, the funds are deducted from your paycheck in equal installments, either monthly or according to your employer's pay cycle. For example, if you enroll in a Health Care FSA for $1,200, $100 will be deducted from each paycheck monthly, but you can begin using the full $1,200 for eligible medical expenses as early as January 1st. How to submit claims for Health Care FSA. There are two main systems depending on your employer. Reimbursement system, you pay for medical expenses out of pocket, then submit receipts to the FSA administrator via email, fax, or online upload. Once approved, the amount is reimbursed to your linked bank account. Debit card system, your FSA administrator issues a debit card which you can use directly at medical facilities to pay for eligible expenses. Even if you use the debit card, you may still be required to submit receipts later by scanning and uploading them online. You'll typically receive a notification requesting this documentation. Purchases made at the pharmacy counter for prescription medications are often exempt from this requirement. Receipts must include the name of the medical provider, the date of service, your name. In my case, Fidelity managed the FSA at my workplace. For prescriptions, I wasn't asked to submit receipts. However, for medical treatments, I received an email a few days later requesting the receipt. Submitting it was easy. I went to Fidelity's FSA page, clicked on Account, and found a message with a button to upload the receipt directly. Always make sure to get a receipt, no matter what the situation is. You never know when you'll need it. Now, what happens to any unused funds? You can use the FSA funds for medical expenses incurred between January 1st and December 31st. After that period, any remaining balance is forfeited and becomes the property of your employer. However, since the pandemic, if your employer has applied for approval through the IRS, you may be allowed to carry over up to $660 into the following year. This maximum carryover amount is reviewed and adjusted annually by the IRS. That said, most employers do not offer this carryover option, so it's important to check with your HR department or benefits administrator. What happens if you leave your job? Any unused balance remaining in your FSA account is not refundable upon resignation or termination. On the other hand, if you've already used your full FSA amount before leaving your job, you are generally not required to repay the remaining unpaid contributions. In this case, your employer assumes that financial risk. Now, let's move on to the Dependent Care FSA. The basic idea is this: in order to be able to work, you may need to pay for care services for your dependents, such as daycare, preschool, after-school programs, or day camps. You estimate the total cost of the year, set the amount aside from your pre-tax salary, and it is automatically deducted and deposited into a separate account. This makes the funds tax-free. It's important to note that this account is strictly for work-related care expenses. Educational expenses such as tuitions are not eligible. Eligible services include daycare centers, preschool programs, babysitters or nannies, before after-school programs provided by schools. As for age eligibility, children under the age of 13 qualify. For child care purposes, children 13 and older are generally not eligible. Unless they have a disability or require specialized care, you can also use this account to pay for care services for a spouse or elderly dependent who is unable to care for themselves. For more details, please check with your company's HR department or consult the IRS website directory. As for the annual contribution limits, they are outlined in the following chart. For the 2025 plan year, the maximum contribution limit for a household is $5,000. If you and your spouse file taxes separately, the individual limit is $2,500. Like the Health Care FSA, contributions are automatically deducted from your pre-tax salary, meaning they are not subject to income or payroll taxes. In other words, you save the amount you would have paid in taxes. For example, about my friend who lived in Hawaii, she set up a dependent care FSA with a full $5,000 contribution with a federal income tax rate of around 20% and a state income tax rate of about 10%. She saved approximately 30% or $1,500. That's a significant benefit. However, the system and usage rules differ from the Healthcare FSA, so it's important to understand those differences. When you enroll, you choose your annual contribution amount. Like the Healthcare FSA, deductions are made monthly or according to your pay cycle. But with the Dependent Care FSA, you can only use the funds that have already been deducted and accumulated, not the full annual amount upfront. How to submit claims for Dependent Care FSA. Claims are typically handled through reimbursement. You pay for eligible expenses out of pocket, then submit receipts via email, fax, or online upload to the FSA administrator. Once approved, the funds are reimbursed to your linked bank account. What happens to unused funds? Funds must be used for expenses incurred between January 1st and December 31st. Any unused balance is non-refundable and is retained by your employer. However, some employers allow a grace period of up to 2.5 months into the following year, but only if they've approved for this option through the IRS. Be sure to check with your HR department to see if this applies to your company. Key difference between Health FSA and Dependent Care FSA. With a Health FSA, the full annual amount is available to use starting January 1st, even if it hasn't yet been deducted from your paycheck. With the Dependent Care FSA, you can only use the amount that has already been deducted. It's a pay-as-you-go system, not a pre-funded one. In both cases, unused funds are not refunded after you leave your job. However, if you've used your full healthcare FSA amount before leaving, you are not required to repay the remaining unpaid contributions. Your employer absorbs the cost. With a Dependent Care FSA, you can only use what you've actually paid in, so there's no repayment obligation, but also no access to unpaid funds. Let's wrap things up. There are two types of flexible spending accounts, FSAs, Healthcare FSA and Dependent Care FSA. Enrollment is available once a year during your company's annual benefits review period. Contributions are deducted from your pre-tax salary, making them tax-free and helping you save on taxes. Each account has a maximum annual contribution limit. If you don't use the full amount within the plan year, the remaining balance will not be refunded, so it's important to carefully estimate how much you'll need. I encourage you to take full advantage of this system and enjoy the tax savings. Today, I introduce FSAs, flexible spending accounts, as a way for employees to save 20% to 30% on medical and daycare expenses. I hope this information was helpful to you, even just a little. If you found this video useful, please consider giving it a thumbs up or subscribing to support the channel. Thank you so much for watching. See you in the next video, and until then, take care. Bye.